Are you watching your portfolio bleed out right now? You're not alone. The market's been brutal lately, especially for tech stocks like NVIDIA. But what if I told you there's a simple rule that could have helped you avoid some of these losses? It's called the 50-30-20 rule, and it's used by one of the most successful investors of all time. I've spent hours analyzing charts, crunching numbers, and breaking down complex market dynamics to bring you this powerful insight. Stick around, and I'll show you how to use this rule to potentially save thousands on your next investment decision. Let's talk about the 50-30-20 rule and the investing legend behind it. This rule comes from Stanley Druckenmiller, a Wall Street titan who worked alongside George Soros for years. Druckenmiller's not just another talking head. He averaged a 30% annual return over nearly 2 decades. That's insane. He's the guy who helped break the Bank of England, pocketing a cool billion in a single day. So when Druckenmiller speaks, smart investors listen. His 50-30-20 rule is simple, but powerful. It breaks down stock movement like this: 50% comes from the overall market, 30% from the sector, and only 20% from the individual stock itself. This insight can completely change how you approach investing. Let's dive deeper and see how it works in today's market. All right, let's take a quick look at what's been happening in the market lately. If you've been paying attention, you've probably noticed it's been a rough ride, especially for tech stocks. We've seen the Nasdaq take a significant hit, dropping for several weeks straight. This isn't just a little dip. We're talking about a clear downward trend. Big names like NVIDIA, which were soaring earlier this year, have taken a beating. We're seeing lower highs and lower lows, a classic sign of a downtrend. And it's not just 1 or 2 stocks. This is a broad market movement. Understanding this bigger picture is crucial because, as Druckenmiller's rule suggests, it's driving half of what's happening to individual stocks. This downturn sets the stage for why the 50-30-20 rule is so important right now. Now, let's zoom in on market sectors. Think of sectors like neighborhoods in the stock market city. We've got tech, healthcare, energy, and more. Each sector has its own vibe, and right now, tech is feeling the heat. Remember, Druckenmiller's rule says 30% of a stock's movement comes from its sector. That's huge. Take the tech sector ETF, XLK. It's been hit harder than the broader market. This matters because even if you love a particular tech stock, if its whole neighborhood is struggling, it's going to have a tough time. It's like trying to sell a great house in a declining area. Not impossible, but definitely harder. This sector weakness is why even strong companies like NVIDIA are struggling. Understanding sector dynamics isn't just for Wall Street pros. It's a key part of smart investing for all of us. Let's put this all together by looking at NVIDIA. Earlier this year, NVIDIA was the darling of Wall Street, but since mid-June, it's dropped nearly 28%. Ouch! That's a lot of people's gains wiped out. But here's where it gets interesting. If you were watching closely, you could have seen this coming. NVIDIA's chart showed classic signs of trouble brewing. It failed to make new highs, then broke below key support levels. This wasn't just NVIDIA being NVIDIA. It was following the script written by the broader market and tech sector. Remember, Druckenmiller's rule says only 20% of this move is about NVIDIA itself. The rest? It's the market and sector dragging it down. This is why blindly buying a stock, even a popular one like NVIDIA, without considering the bigger picture, can be dangerous. It's not just about picking good companies. It's about understanding the forces affecting them. Now, let's break down NVIDIA's recent performance using the 50-30-20 rule. First, the 50%, the overall market. We've seen the Nasdaq trending down, pulling stocks like NVIDIA with it. That's half the battle right there. Next, the 30%, the tech sector. As we saw, tech's been hit even harder than the broader market. NVIDIA, being a tech stock, couldn't escape this sector-wide downturn. Finally, the 20%. NVIDIA itself. Sure, there might be company-specific news or earnings reports affecting the stock, but Druckenmiller's rule suggests this plays a smaller role than most people think. This breakdown explains why NVIDIA fell so hard despite its strong fundamentals. It's not just about the company, it's about the bigger forces at play. Understanding this can help you make smarter investment decisions and potentially avoid significant losses. Let's talk about some common pitfalls that trip up many retail investors. First, there's the tendency to focus too much on individual stocks and ignore the bigger picture. As we've seen with NVIDIA, that can be a costly mistake. Another big one is chasing past performance. Just because a stock was hot last month doesn't mean it'll stay hot, especially if the market or sector turns south. Many investors also fall into the trap of emotional decision-making, panic selling during downturns, or FOMO buying during rallies. And here's a sneaky one: neglecting to regularly rebalance your portfolio. The market's always moving, and your asset allocation can drift off target if you're not paying attention. Lastly, there's the mistake of not having a clear investment strategy. Without a plan, it's easy to get swayed by market noise and make impulsive decisions. Avoiding these mistakes and applying the 50-30-20 rule can significantly improve your investing game. So, how can you use the 50-30-20 rule to boost your investing game? Start by zooming out. Before buying any stock, check the overall market trend. Is it bullish or bearish? That's your 50%. Next, analyze the sector. Is it outperforming or underperforming the broader market? That's your 30%. Only then should you dive into the specifics of the stock itself. That's your 20%. This approach can help you avoid buying great companies at the wrong time. It can also alert you to potential problems with your current holdings. Remember, even the best stocks struggle in a falling market or weak sector. Use this rule to time your entries and exits better, and to maintain a balanced, diversified portfolio. It's not about never taking risks, but about taking smarter, more calculated risks. Has this video changed how you think about investing? If so, hit that like button and subscribe for more market insights. And here's a question for you. How might the 50-30-20 rule change your approach to your biggest current investment? Drop your thoughts in the comments below.